Well, why don't you have a look at that? We call that Red Dead Redemption. We call that getting your flapjacks flipped straight on the floor. Oof, what a heat map today. What a heat map today. $136,000 down. We call that getting destroyed in the market. Oh, baby. You gotta love it, right? Public account having a tough one. Why is that? Well, look at the moves down. Meta 5+%. Tesla, Tesla 12+% here today. Amazon's 3% mover. Palantir 7% plus. Cake got hammered today, 4.5%. Guess can't afford to eat a cheesecake tonight, huh? Nvidia 6.8% down. Oh, look at the moves. 46,000 down, 51,000 down. Oh my gosh. Ford Motor Company, by the way, down after hours, 11+%. They took a $1.1 billion EV loss in the quarter. Absolutely vicious in regards to that. Check this out. Ford Motor Company is lower than before I was born, folks. How crazy is that? Lower than before I was born. Like, that's one of those things you hear and you're like, what? Like, but literally, look at where the stock was back then. It was 13 something dollars. It's $12 today. It's lower than when I was born, right? Chipotle. So I'm looking at my Chipotle puts before the market closed here today, and I was thinking, man, I could get out of these with some good profits on some of them. Some of them take small losses. Maybe it makes sense to kind of move out of this. And I considered it for a bit. But then I looked back at my conviction around kind of what's happening, what I believed was going to happen with margins kind of moving forward and things like that. And I'm like, let me keep that on, right? Let me keep all my puts out there. And I didn't take any profits, right? I took some last week, but I didn't take any today. And then the earnings came out, right? And remember, this is for the April, May, June quarter, right? And I see total revenue increased 18%. I see comp restaurant sales up 11%. Operating margin looked really good. I'm like, you gotta be flipping my flapjacks. No. This can't be. And then I'm thinking, okay, where's the guide? Where's the guidance at? Because that was kind of one of my things. It wasn't just about this quarter. It's about what the guidance is going to be, right? That's why I'm hedging against this one. And then they put out this guidance. I'm like, what kind of guidance is this? Full year comp restaurant sales growth of mid to high single digits. Okay, that's helpful. And then they give their restaurant guide, which everybody and their grandma already knows. And then they say an estimated underlying effective full year tax rate between 25 and 27%. I'm like, what kind of guide is that? Like, this is a horrible guidance. Like, just give us some more details in regards to that, right? And so I'm like, oh, this is not good, right? And next thing you know, the stock's up 8%. It's up at 10%. It's up 12%, right? And then Mr. Taco Bell goes on CNBC, and he just makes it sound like everything's just the greatest ever at Chipotle. Holy smokes, this ain't no jokers, right? And I'm just like, oh my gosh. Next thing you know, he's getting off the airwaves, and the stock's up like 14%, right? Pushing close to 60, and I'm like, there goes all my profit. There goes all my profit, right? And maybe even put some of anyone that are profitable, put them into losses, right? And I'm like, oh man, vicious. But then everything changed in a massive way. And you know why? Well, the CFO, they finally dragged it out of him about 30 minutes or so into the conference call. They finally dragged it out of him. And the Chipotle CFO, who's the outgoing CFO, he says, margins, they're going to be under pressure for the next few quarters, right? And that changed everything. So this was, when it came to hedging Chipotle, it was about comp store sales could be hit, margins could be under pressure, right? They're facing all these wage pressures, including in their biggest market, California. And then additionally, everybody and their grandma, this thing's gone viral over the last quarter, right? It went viral back in May and June about them skimping out on bowls, and you're going to have to give customers you're going to have to make Chipotle like the old Chipotle, or you're going to get absolutely roasted. People are going to share it with their friends and family, put it all over social media. If you give somebody a small burrito or a small bowl, that's going to hurt margins. There's no other way around that. If you're going to have to be forced to give people more food and you're not going to be able to skimp out, it's going to hurt margins, right? And so they finally dragged it out of them. And sure enough, the stock obviously changed in quite a substantial way. We'll see what happens to it moving forward, but I'm feeling pretty confident because now that everybody knows pressures are going to be under margin, I think that's going to freak a lot of people out. And Chipotle, one of the beautiful things about that was always a great margin, company, and I think those margins definitely are going to be under a lot of pressure. And I think they try, in my personal opinion, is they try to make it sound a lot better than what the reality is going to be over the next few quarters. We'll see in regards to that, right? No, everybody's freaking out. Oh my gosh, holy smokers, this ain't no joke, because everybody's freaking out over this. I don't say everybody, but a lot of people are freaking out. A lot of people, Wall Street is freaking out over this move, down here for a lot of these big tech stocks recently. Big tech was on fire. It could do no wrong for really like 18 months. And then all of a sudden, really in like the past couple weeks, we've seen a lot of these stocks fall quite considerably, and everybody's starting to freak out in regards to this, right? Now, I posted this on my X. If you don't follow me on X, what the heck are you doing? By the way, thank you for everybody that's subscribed here to the channel. I appreciate y'all joining me here today, right? But I posted this on my X, right? I said, worst day for tech stocks since December 2022, which seems like a long time ago, right? I said, keep in mind, the NASDAQ's up 16% in 2024, right? That's after today's move down. The S&P 500 is up 14% in 2024. I said, we're due for some chill out time. And, I'll be buying stocks on Friday. I buy stocks pretty much every single Friday, right? And sometimes when the market's been so good, people take it for granted and they assume like the market only goes up every single day and it can never go down. It's never going to have a tough day. Listen, if you're gonna have a market beasting on the upward trajectory and it's just flying high, which is exactly the market we had, you better be prepared for some vicious downward moves. And I can tell you, markets that seem like they go up in a straight line, they have some of the most vicious downward moves you can ever imagine. And they have some huge freak out periods where everybody just all of a sudden starts to panic, and everybody's been so caught up in a buying mode on Wall Street that all of a sudden people start getting panicked and they start selling. And the algos start selling, people's stop losses start getting hit. People that were buying maybe at bad prices start going underwater. They start freaking out. It's a whole situation to go through, right? And so for you as an investor, the important thing for you to take away from a day like today is this is natural. This is going to happen in the future. You're going to have much bigger downward moves than what happened today. Today's child's play compared to some moves you're going to face in the market. And if you can't handle the day like today, you can't handle the market. You might as well stick your money under a mattress and be broke forever, okay? Because that's what you will be unless you can start a really successful business, which you're not going to do because if you can't even invest, then you can't take any risk tolerance, which means you definitely will never start a business. So then you're just broke for life, right? So if you want any real money in this world, days like this, you're going to have to take them. Keep in mind, there's individuals today, Elon Musk comes to mind, Jensen comes to mind, that lost billions of dollars. We're not talking thousands. We're not talking hundreds of thousands. We're not talking millions. We're not talking hundreds of millions. They were down billions of dollars today. Their net worth went down by billions. So little food for thought in regards to that. Let that sink in, right? Now, I've been through so many of these big downward markets, right? And I think you can learn a lot from the ones I've been through. I graduated high school May 2008, right? And I enter college August 2008. Not really sure what I'm going to do in my life. I knew I was going to run track in college, but wasn't really sure what direction I was going to go with schooling. I signed up for some of the base level classes you take and maybe like 1 or 2 business courses that first semester, right? And lucky enough, I had a good professor or two, and I started learning a little bit about the market, right? And I started learning a little bit about business, investing. It kind of started to pique my interest, right? And so I started paying attention to stocks, started kind of dabbling in the market. I started buying some Walgreens stocks. I was working for Walgreens at this time, set up a Fidelity account back then, right? And this is kind of around October 2008, which was an absolutely vicious crash going on in the market at that particular time, right? And the crash didn't really end until the crash ended around March of 2009. So keep that in mind, right? And it was just an incredible crash. And so what a time period to be getting in the market, because I can tell you no one had anything good to say about the market at that time. They only had bad things to say. The market was just in a vicious downstream that started way back in 2007. And by that time, people were done with it, right? We saw the indexes peak to trough from where they peaked at in 07 to where they bottomed at in 09. All the major indexes fell 50%. They all fell 50%. An absolutely brutal crash. It was the most brutal crash, really anybody had experienced in recent times, right? The only thing that was somewhat comparable was a tech bubble, but that was heavier on tech stocks, which a lot of people were not really in unless they were like super trader type folks. but the masses hadn't really felt a crash like that. And since really like the 80s, just to be quite frank, and the masses felt that. When the S&P 500 goes down 50%, everybody feels that. And so what a time to get started in the market, right? And a lot of people said you shouldn't. Obviously, it was a great time to get started in the market. And that right off the bat kind of set a tone for me of like, oh, this thing could be crazy. Like we're going to have some downdrafts here getting started in that, right? So then I'm investing, time's going along, right? I'm slowly starting to build up my portfolios. I think I hit the 4-figure club, baby, sometime roughly in here, right? 4 figures, baby. I'm doing big time. Now, then we have this situation in 2010. I can't remember what happened. I think it was double dip recession fears came up around this time because we were kind of climbing out of the recession a little bit, but there was still a lot of worry about the economy. Into 2010, a lot of people were very concerned about the state of the economy. Unemployment was still very, very high. A lot of businesses still weren't doing well. Some Wall Street companies were starting to come back with their earnings very nicely, but you had a lot of companies that were, you're struggling. And then additionally, a lot of people felt like the market pushed too much, too fast, coming off of the great financial crisis. And the thing you got to remember coming out of a crash, okay? Very important everybody understands this. When you're in a very excited market and you're just moving up, right? You can experience a very strong, fast crash on the other side because people aren't really taking much for profits. People haven't been panicked in a long time. And so there could be a huge freak out and a massive sellout. If suddenly you have not many buyers while everybody's putting selling pressure, you can get the whole market to sink in an insane way, right? And a lot of people pull back on their buying if they hear, recession, or there might be a recession or something like that, right? The same exact thing is true on the other side. When you've been through a crash, I'm dropping gems for you here, everybody and their grandma is selling out of stocks, right? They're putting massive selling pressure. You by the end of it, you can't find anybody else. Like everybody that wanted to sell is already sold. And then when things start to look a little better, the market rockets higher, way faster than anybody anticipated. And if you miss it, it's long gone. And the reason that happens is because everybody's sold out of stocks. And then when you just start to get a little buying pressure come in the market, oh my gosh, we saw that in 2022, right? I mean, everybody that wanted to sell stocks sold stocks from basically the end of 21 through the end of 2022. And then coming out of that, stocks roared higher. It wasn't just on AI optimism. It was on the back of companies' earnings getting better in the back half of the year or 2023, right? But additionally, and people the market kind of seeing that before, it actually happened, right? But additionally, you had so much buying pressure come in, and everybody that wanted to sell was already sold at that point in time. The bears had already gone full bearish, right? It wasn't like it was a new bear coming to the market going into 2023. Like if you were bearish, you were already long bearish. And so that's exactly what happened here in this whole situation, right? We had a blasting higher market and it was time for a chill out period, and you compound that with double dip recession fears, boom. Then we had this situation here where the Dow went from 12,700 all the way down to 10,700. These are vicious moves down, by the way. I mean, we're talking a lot of these moves I'm showing you are 10, 20% moves down for the Dow, right? I can't even remember what this was. I think we had like a weak GDP number or something like that. But I honestly can't even remember what happened during that time period. Now at this point in time, I'm working for Quick Trip. I'm in management. And honestly, I don't even care about any drops in the market because I'm now at this point in time, I'm putting $1,000 plus in my portfolio every 2 weeks. $1,000 plus every 2 weeks. Boom, 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 baby. And I'm just investing beast. And I'm like, I'm loving life, okay? I've got my first good job, making some money, moved out of my parents' house. It's all good to me. Send that market down. I don't even remember like what was going on at that time. All I know is I was making money. I was investing money, right? And I was feeling really, really freaking good. Then we had these two crashes. This was in 2012, right? And we had this one here where the Dow dropped from about 13,300 down to about 12,100. And then we had this little crash here that Dow was at about 13,600. We crashed that baby down 1,000 plus points real quick there. And neither one of those, I remember what happened. Neither one. I don't know. Like I can't tell you what happened in that situation. This was probably, my hunch is this was probably election fears around that particular time, right? Because right around the time that the election happens. So some sort of fear And then after we got through the election, you can see, because this is November, so election's right around here, boom, market blasts higher, right? Blasts higher. And the thing is you think you got to understand, is the market gets all freaked out. A lot of people wanted Romney. I'll be honest with you guys. A lot of people on Wall Street, they wanted Romney. A lot of people were done with Obama after that first term. And I'm talking Wall Street or specific. I remember, a lot of people going on CNBC talking up Romney, talking about we need him. A lot of people wanted him to lead the economy. Obama did not have a lot of fans when it came to Wall Streeters at that particular time, right? And yet, he ends up getting reelected and the market just ends up blasting higher. And that's going to be another lesson we're going to come back to in just a moment in regards to another election. You'll see shortly, okay? So, but anyways, I can't even remember what happened in that situation. But the Dow went down a bunch, right? And then we're to this time. By this time, now we're in 2014. I got six figures. I'm approaching $200,000 in my portfolio, right? We had this crash here early 14. We went from about 16,600 on the Dow, 16,700, down to about 15,400. Major kind of short-term crash there. Then we had this crash here. This one was Dow was like 17,200, and we pushed it down to about 16,100. And if I recall, one of those was Ebola. Now, Ebola was talked about, if I recall, it was 2014. I swear this was, if I recall, I left Quick Trip though. So if I left Quick Trip, then it had to be late 2014 when it was Ebola, or it had to be early 2015. But anyways, Ebola was a thing that was talked about for a while. People got really freaked out over that. That's why I didn't take Rona that serious when I first started hearing about it, because I remember hearing about Ebola back in it was either 2014 or 2015, and obviously that never became anything, but the market freaked out there. Then we had this one. Ooh, I remember this one. This was painful to go through. This was the summer of 2015. We had a China growth scare along with recession fears for the U.S. A lot of people were fearful the U.S. was going to go into recession in 2016, and you compound that with China growth scare. China's growth had been extraordinary for a long time, and there was a lot of worries about where China was going from here in regards to their growth rates. And man, that was vicious to go through. And I was not working at that time. I had taken over a year off. I left Quick Trip, didn't do anything for over a year. And, my first son was born, right? So I took his whole first year of life off and just, chilled. I still invested during that time. And I was messing around with margin at this time as well. So it was not good. It was a brutal situation. And out of that, I was like, man, I need to start some businesses. I need to get rolling. Out of that, I ended up starting my real estate marketing company at the end of 2015, going into 2016, right? And started realizing I can't just sit around all day and watch stocks, or I'm gonna end up trading more often than I should. I'm gonna end up getting into stuff like margin, screwing up. I need to be focused on something outside of just looking at stocks, because I used to just have one of my iPads set up on the desk. And then I would have CNBC and a TV. I had this little office room. It was basically like a third bedroom I converted into an office. I would just have a CNBC on all day. I'd have my iPad there, right? One of my iPads there, just with the whatever stock tracking app I was using at that particular time, just open, right? I'd be playing, Clash of Clans, but just screwing off, not doing anything. And then it would lead me to want to do more earnings trades, and I was in and out of stocks. I was going against everything that made me successful. But I remember that. It was vicious. It was vicious to go through, right? This one, early 2016, I don't even remember. 17. We were at about 17,800, almost 18,000 on the Dow, and we pushed that baby down to 15,600. I don't even remember what happened in that situation, right? Then we had this one here. This was election worries. We went from about Dow 18,500 down to about 17,800. There was election worries. Then Trump got elected, and the market took off. The market absolutely took off, right? And there was a lot of fear around, if Trump gets elected, that's not going to be good for the market. And that surprised everybody. No, I don't even think Trump was expecting to be elected, to be honest. No one was. And he won. And everybody's like, what? And the market absolutely freaking took off after that happened. And that was a time. But there was that situation, right? Then right here, this is in 2018, Trump was getting very vocal about tariffs, about trade wars. He was tweeting like a madman at that particular time. And also the positive Trump effect had worn off. So when Trump first got in office, there was a lot of positive, kind of what I call Trump effect in regards to the market. And the reason was he dropped corporate taxes from 35% down to 21%, which was like the biggest thing you could pretty much do for the stock market, right? And so that was like glorious. And then after that, the positive Trump effect started to wear off, and a lot of the negatives started to come in. Trade wars, tariffs, all those sorts of things. The market didn't like any of that because you're talking about you're disrupting supply chains, you're disrupting companies' profits, you're completely changing the way companies have to invest, and all those sorts of things are not good things for a company in the short term, right? And so you could make an argument that it might be good or bad for a country over the long term, but for companies over the short term, it's not good when they have to all of a sudden make this adjustment, that adjustment, and then you get a tick-for-tack war with China and other countries where it's like, okay, you're going to put tariffs on this, we're putting tariffs on that, and it creates more uncertainty, right? And then Trump, like he was tweeting like insane back then, man. It was crazy, and so every day the market had something to freak out over, and the Dow went from about 26,600 down to about 23,600. So we dropped about 3,000 points in the Dow in a pretty quick amount of time there, right? Then we had this crash. This was brutal. This was brutal to go through. I'm telling you guys. We're pushing Dow close to 27,000, and then the Dow pushed all the way into the 21,000 range. And this was very late 2018. I call it the Q4 crash of 2018. It was brutal, man. And this was on the back of the Fed was starting to raise rates, right? And a lot of people did not believe the market could withstand rates being risen. And a lot of people, whenever the Fed starts raising rates, the market freaks out. And it honestly kind of makes sense. Why does the market freak out? Well, think about this logically for a moment. You don't know when the Fed's going to stop raising, when they start raising, right? No one knows where the finish line is. So the Fed starting to raise rates back then, it got a lot of people very concerned because they looked out there and they're like, okay, the Fed's starting to raise. We don't know when they're going to stop raising, right? And it freaked the market out. So the market freaks out, right? The Fed gets concerned about that, even if they don't want to admit it. Jay Powell's now in the Fed chair role, right? And then Trump also comes out and puts a lot of pressure on the Fed that you need to start lowering rates. Why are you raising rates? This is unfair. Obama had low rates the whole time. Why are we having high rates? This doesn't make sense, right? And between what Trump was saying and between the market reaction, which was insanely negative and very fearful, the Fed backed off. And the Fed stopped raising rates in going into 2019. And the market blasted higher after that. But it was very painful to go through at that particular time. I posted this on my Instagram back in 2018, December 7th, 2018. I said, as I sit here on a Friday night, December 7th, 2018, I see countless great stocks trading at insanely low valuations in comparison to their future growth potential. I see most companies valued like we are going to have a pretty good-sized recession in 2019. It is possible, as it is always every year, which is something I still actually say nowadays, right? If we do have a recession in 2019, then this all makes sense. But if we don't, this is one of the best buying opportunities of my life. Regardless of what happens short term, I am a long-term player, right? And there's no doubt it was a phenomenal time to be a buyer of stocks. You go back, if you want to have some fun, go back and look at what Apple stock was valued back in December of 2018. Go look at NVIDIA. Go look at Meta. Go look at Google. Go look at Amazon. Go look at AMD. All the companies that we look at as like hero companies nowadays, go look at them all. Go look at Tesla. Tell me what those stock prices were back on the night of December 7th, 2018. And tell me what those stock prices are now. Tell me how much they appreciated. You want to have your mind blown? Shoo, baby. Have fun with that one. I remember this. I posted this on December 22nd, 2018. I remember I was at this nice resort, Camelback Mountain, with my wife. And beautiful resort. I can't remember the name of it, but it was very, very nice. We had a great room. We had a great time. There was this like fire pit outside there, and I took this this photo. I said, "This is a live photo of the stock market in December." For those that don't know, we're having the worst December for stocks since the Great Depression, and yes, we were. The very end of that month, the market came back a bit, but prior to that, literally at this time I had posted, we were on pace for the worst December since the Great Depression. Let that sink in for a moment. Since the Great Depression. Worse in 08, worse in 09, worse than any time. Incredible, right? And that's the market we went through. You want to talk about a market to freak out in? Whew, a lot of people were freaking out at that time. Yeah, when you got a headline like that, it's no bueno. Who's around? Who's investing back then? Who was investing back then, man? Let me know. Then we had the Rona crash. Ooh, was that fun, right? We had the Dow pushing close to 30,000 right prior to Rona. And then next thing you know, the Dow's like 18,000. I mean, oh my gosh. And I think it went even lower than that, I feel like. But even if it went to 18,000, that was the lowest. I mean, from close to 30,000 down to 18,000, brutal, right? And that was a very scary one. And the reason that was so scary is we didn't know how long the economy was going to be closed down. We had no clue, right? Like there was talk that 3 years. There was talk that 3 years things were going to be closed down. No one knew what this meant for debt. No one knew what this meant for evictions. No one knew what this meant for the unemployment rate. People were talking about 20, 30% unemployment rates. People were talking about unemployment higher than the Great Depression. Like, and it just took the world by storm. We know what that was, right? That was a crazy, crazy time. I mean, you had to live in it to be in it, right? That even makes sense. Well, I guess that did make sense, actually. Then we had the Q4 2021 through Q4 2022 crash. Whew, was that brutal, right? Nasty. And I mean, that was one where, everybody got hit. But certain stocks got hit the hardest. What got hit the hardest? The stocks everybody actually loves to invest in. Big tech. Big tech got brutalized, right? Meta, Shopify, Apple, Microsoft, Google, Amazon, Tesla. It was everybody. And I mean, if you were tech related and your stock only fell 30% peak to trough or 35%, you were winning. Because there were countless great companies down 50, 60, and 70% in that crash. Netflix, I mean, you just go through the list, we're talking 50, 60, 70. We had not seen tech stocks fall that hard since, honestly, the tech bubble went kaboom. That's how long you got to go back for. I mean, there was some of these big tech companies were getting hit harder in that than they got hit in the great financial crisis. It was insane, right? And the reason was you had some overvaluation in the market, right? There was too much growth priced in. We had a growth scare, right, where growth went down. It wasn't just a scare, it was reality. Compound that with the Fed raising rates at the fastest clip we ever seen in history, and compound that with real inflation that's out of control. And no one really in any generations recently had seen inflation like that. The only people that had seen inflation like that were back in the 1970s and the early 80s. And so if you were Gen X, you never seen that. If you're a millennial, you never seen that. If you're Gen Z, certainly you never seen that. And if you're a baby boomer, you were like a little guy back then, right? You were super young, so you probably didn't even remember it. So you have to go really back to prior to the baby boomer generation to really find people that had really felt inflation of the 1970s, right? And so that freaked everybody out because everybody was like, we never dealt with this before. And so that was an epic crash, right? Absolutely crazy. So, and then we had this one recently, right? This was last year where the Dow went from about 35,600 down to about 32,400. So we dropped 3,000 plus points on the Dow there. And that was just inflation 2.0 scare. That kind of, people thought CPI was going back higher. They were afraid maybe the Fed's not done raising. And obviously the market moved down. And then we bottomed out around November and we headed up from there, right? So I show you all that there, and I show you all these market corrections, crashes we went through just since I've been investing in the market. And the reason I show you that is so you understand days like today are going to happen, but they're going to be a lot worse than this in the future, right? And that's just part of the market. And there's nothing wrong with that. If I don't know. As little John would say, if you're scared, go to church. Reasons to sell. Look at this here, right? So reasons to sell. This is 2009 through 2013. Jobs, crazy amount of jobs lost here. You had Chrysler, General Motors file bankruptcy. BP oil spill. That was interesting. That was the first time I realized I was really cut out for the market, because that BP oil spill happened, right? And by this time, knew how to read income statements, balance sheets, and things like that. I'd already gone through at least one level of accounting or a couple levels of accounting. So I knew how to do basic stuff like that. And I kind of knew how to value stocks that are like oil and gas stocks, right? And so the BP oil spill happens, the stock crashes. And I looked at the company and I said, they can get through this. They're going to be able to get through this. And a lot of people were very fearful that BP was going to go bankrupt. And I looked at their balance sheet. I kind of looked at their income statement. I said, they're going to be able to get through this to the other side. And so I actually bought the stock. And I think I put a few $100 in it, because keep in mind, I had a very low net worth at that particular time, which a few $100 for me was actually a substantial amount of money. And I made money in the short term. It was I did it a little bit more of a trade, right? And I got out of the stock and I made money. But that was the first time I knew, like, oh, I can do this. Because that was going contrarian against everybody. People were talking about this company's going bankrupt. I had an opinion that was different. I actually put money on the table, made money, and moved on. And that was kind of that situation, right? So sometimes you got to have that moment in the market, and you know if you're cut out for this game or you're not cut out for this game, right? Oh, we had the most powerful earthquake to ever hit right here. S&P 500 or S&P downgrades U.S. debt. Yeah, that was right. Yep, the downgrade of the U.S. debt. I forgot all about that. That was a freak out in the market. People were panicked over that because they're like, I don't know if the U.S. debt had ever been downgraded at that time. I think that's why it was such a big deal. I don't think we'd ever gone through a downgrade or something like that, because I do remember like on CNBC they were talking about that all the time, right? Oh, the flash crash, that was a fun one. Procter & Gamble stock went down huge. Kramer was talking about it live on air. What a crazy situation that was. European sovereign debt crisis. Yes, Europe used to get talked about so much back then. Now no one even cares about Europe in regards to the markets. But back then, oh my gosh, Europe. Oh, what happened? What country defaulted now, right? We had a stock market crash there, a little mini crash, right? Fiscal cliff talks send stocks lower. Oh yeah, that's always the one that the market can pull out at any time. The fiscal cliff, right? And then the can gets kicked down the road and we moved on to the next thing. The Dow had 5 positive days in a month for the first time since 1968. Oh, only 5 positive days. Oh, man. Yeah. We had U.S. government shutdown. Oh, that's another thing that comes and goes. You'll hear the amount of times you're going to hear in your lifetime about U.S. government shutdown is going to be a lot. Taper tantrum. Oh, yeah, man. Oh, yeah, there's Ebola. There it is, right? U.S. elections. Dow falls 1,000 points for the first time ever. Oh. Global stock market sell-off. Chinese stocks fall 45%. Crude oil bottoms after falling 77%. Oh, yeah. There's that situation. We had Dow fall the biggest point ever, which, I mean, if the Dow keeps going higher and higher, technically you should have the bigger and bigger crash over time, right? Government shutdown, there it is. You're going to hear about that a lot. Trade wars, there it is. Oh, yield curve inverts. Yep. And then, I mean, just thing after thing after thing, right? No, if you're a real estate investor, right, what is your goal as a real estate investor? Well, your goal should be, let's say you start real estate investing, I don't know, 27 years old, right? Your goal should be able to buy your first property, right? Rent that out. Hopefully have it cash flow you over time. Hopefully be able to raise your rent a little bit each year, right? And get a little more money and a little more money. And hopefully that house appreciates over time, right? And some of the excess profits, you can, fix the house up when it has problems, all those sorts of things, right? And then eventually over time, put yourself in a situation where you can buy another house, maybe at age 30 or 32 or something like that, right? So now you have 2 properties under your belt. And then buy another property, maybe you're 35. And then another one when you're 38. Now you have 4 properties. And then another one when you're 40. Now you have 5 properties, right? And now you have more and more cash flow, so you can buy more and more properties. You can do cash out refis to go buy another property, right? Because you probably appreciated some of those early properties. And you want to have more assets, right? The goal is to build more assets, have more properties, making you more and more cash flow so you can put that in the next property, right? That's like the goal as a real estate investor. So what's the goal as a stock market investor? Well, it's very similar. The true goal of a great stock market investor is to own more and more great companies over time, right? And that's your goal. Your goal is not necessarily a bigger and bigger portfolio number. That's a byproduct of owning more and more great companies. If you own more and more great cash flowing companies over time, right? A byproduct of that will be your portfolio goes higher and higher and higher over time, right? You want to make your ownership stake in these companies bigger and bigger and bigger, right? Where maybe you go from 0.0000001% owner to 0.00001% owner, right? And that's a big difference there, especially if you're talking about massive companies. You want to have more and more ownership. You want to own more and more shares of great companies. Your goal is not to time in and out of the market. Now, the problem is the stock market's open every day. You can go right on your phone. You can sell out your entire portfolio. I could sell out of my entire $2 million plus Fidelity account. I could sell out of all those positions, and I could do that in less than a minute. Less than a minute. I could sell the whole thing. You can't do that with real estate. You got a multi-million-dollar portfolio of real estate properties. You can't do that. So people don't even think about, I'm going to try to time in and out of the real estate market. It doesn't work like that, right? But in the stock market, people try to do it all the time because it's so easy. And it's so easy to get freaked out, right? Now, let this sink in for a moment here. They did this, they did all these calculations, which I appreciate them doing this, and they looked at the market for kind of a 20-year span from basically January 03 through December 2022, right? And they basically wanted to know if you missed the best days in the market, how much would that affect your returns? And keep in mind, if you're trying to time in and out of the market, you're going to miss. You're going to miss a lot of the best days in the market, right? And check this out. If you had just invested all the days in the market throughout time, right, you would have turned your initial, $10,000, right, over that 20-year span in the S&P 500, it would have became $64,000. Nice. Your 10,000 became 64,000, right? And that was all you put in. You never put in more money. You never got something that outperformed the market. No, that's it. Okay, you did well for yourself. Now, if you missed just the 10 best days, just 10. Now keep in mind, this is over a 20-year span. So 10 days out of 20 years is like nothing. Remember, most days of your life go by, you never remember. And if you just missed the 10 best days, you now have $29,000 instead of $64,000. You lost over half of your value just because you missed 10 days in the market, right? Let's say you missed the best 20 days in the market, which once again, 20 days out of 20 years is nothing. Now you went from $64,000 to $17,000. If you missed the 30 best days in the market, you're now down to $11,700 from $64,000. If you miss the best 40 days, you're down to $8,000. If you miss the best 50 days, think about that. Let that sink in. If you miss the best 40 days out of 20 years, you lost money in the market. You lost money in the market over that span, which is crazy to think because you know there's going to be a ton of inflation over a 20-year span. And the fact that you would lose value just because you missed the 40 best days is wild. If you miss the best 50 days, you're down to $5,700. If you miss the best 60 days, you're going to be down to $4,000 from $64,000, right? That's incredible. That's incredible. Now, the other thing that's incredible is look right here, okay? When were the 10 best days in the market? Look at when the best days were. The best day ever in the stock market was in 2008. During the great financial crisis, that was the best day ever. The second best day was in 2008, the great financial crisis. The third best day, March 24th, 2020. Rona. March of 2020 was the peak of Rona fear, the ultimate freak out. Look at this. The fourth best day in history, March 13th, 2020. You would think, no. The best days in the market have to be when everything's great, when the economy is great. No. Many times the best days in the market are in the worst markets. March 23rd, 2009. Market goes up over 7% in a day. Remember, that's when the market was bottoming, 2009. April 6th, 2020. Sixth best day in history. The seventh best day in history, November 13th, 2008. Eighth best day, 2008, November. Ninth best day, March 10th, 2009. 10th best day, 2008. All the best days come in the worst times for the stock market. Let that sink in for a moment, folks. That's why you can't mess around with this, and you might think, market's going to crash, market's crashing, I need to be out of the market. You can do that, but you're just going to fail bad, right? And keep in mind, everybody you respect and you look up to, these people don't time in and out. It's not like they're like, oh, I got to sell all my shares in Tesla today and get back in and then sell all my shares in Amazon. No, okay? That's not the way it works. Look at today. Larry Page is down $7.2 billion. Jensen was down $7.2 billion. Bernard, the guy that's LVMH, right? $8.4 billion. Zuckerberg, $9.5 billion. He was down here today. Man, he should have sold all his Meta yesterday. Bought back in tomorrow, right? Elon was, Elon, $17 billion. Elon Musk's net worth dropped today. Literally, he's $17 billion poorer than he was 24 hours ago. Isn't that incredible, right? Doesn't matter in the end. No. Okay, no. At the end of the day, you're better off holding great assets. These guys don't time in and out, and they're not like, oh, I'm selling $10 billion of stock today, and I'm going to buy it back next week. No. Come on, man. You got to play the way the real winners play, and they don't play that game, okay? You're trying to buy assets here, make these assets great. Now, I have something pretty exciting to announce. We put this together over the past month or two, and we just released it in 1000X. And this is going to teach you guys a lot of stuff you need to know: how to decode a balance sheet, how to decode an income statement, how to decode a cash flow statement, how to perform SWOT analysis, how to know if a company has a strong moat versus a weak moat, how to value a dividend stock, how to value a growth stock, Dividend Investing 101 and Portfolio Management 101. Those are going to teach you a lot of subjects there. So if you'd like to access that, I'll put 1000X as a pinned comment down there today. Obviously, you get access to the full software suite as well. But I wanted to add that education part in because I know there's a lot of people that need help with these subjects. And so if you want access to that, click the pinned comment down there, fill in an application, take your knowledge up to a much higher level than where you're at right now, okay? It's time to become a big boy, big girls out there. Much love and have a great day.